Hello, everybody, and welcome to Confident Compounding with Corey Kramer. I was gone for the weekend, but now I'm back. Had quite a few requests for Fortinet stock, ticker FTNT, and I already have it up on the chalkboard. So after the big drop the other day, we're going to do a video on it looking at the valuation right now. As always, this is not individual investing advice, just how I analyze stocks. Okay, so Fortinet, we have history going back to, let's see, 2010 it looks like. So no recession data from the Great Recession. And, you know, things were kind of pretty choppy during most of this period until 2018. That was also a tax cut year, so I don't know how much of that could have been due to U.S. tax cuts and how much due to actual growth. But it kind of got off to a slow start. So they're in the software business. I want to say like internet security is the way to kind of think about that. And pretty big company. They're 56 billion now, even after the big decline in the stock price last week. Let's make this a little bit more current here. So once we get into kind of the era we're in now, we have earnings growth over 30%. If we take it from back to 2016 through 2027's expected earnings, let's shrink this a little bit more to 2018. Let's get 2019. There we go. A little bit more steady and flat, a little bit more near term. We're still over 30% earnings growth. So super fast growing stock. So I bought this stock in May of 2022, so April, May, right down near this little bottom here. And it kind of fluctuated for a while, but if you look at the earnings growth going into that period over the previous 3 years, we have 34%, 36%, 19%, and then that year they went on to almost grow earnings 50%. So we had a really fast-growing business, pretty decent size. The stock price had been falling, and it got down to about a 57 PE, but by the end of the year, it was at a 40 PE. So when earnings are growing 50%, that multiple compresses, and I might have been using kind of forward estimates when I bought it. So it seemed like a pretty decent growth stock. So I bought this using my growth strategy. Typically, that's a buy and hold strategy for the long term, where you don't really sell the stock. But this was an interesting, because I don't think I've ever sold any stocks for value. The idea is you don't want the valuation to get you out of the stock. So when you have a period like this where the valuation kind of spikes up in 2023, you don't want to be trying to trade these little dips here. You just want to hold it for the longer term returns over the very long term. Now this is only like 3 years, but if we just go up to the top here a couple months ago, when I decided to sell it, it was almost a 100% return at that time over 3 years. So, and I ended up selling half of it because what had happened was the earnings growth had actually slowed so that I didn't really consider it a fast growth business anymore. These years were good, but this year had slowed to 6%. And then some of the other metrics I looked at, it looked overvalued on a long-term basis. So I kind of split the difference with my strategy, and I said, well, the valuation looks really high, and I'll show you what it is, what it was here in a minute. So I ended up selling it right before the big sell-off that occurred last week, selling half of it. So I still have half, and then holding the rest, and we'll kind of see what happens, because the earnings growth had fallen 6% this year. But when we look forward, it's like 11% to 13%. And that's more like a normal growth business and not like a fast growth business that's growing, 30% on average like it had been or more. So when you get to low teens earnings growth, then a 30 PE, which is what it trades at right now, is, pretty okay. Well, we'll look at it, but I mean, just on its face, that's not super cheap, right? Now, if you have a 30 PE and you're growing earnings at 49% and 37% and 45%, okay, well that's not super expensive. But once earnings growth slows, you're going to get this multiple compression, which is basically what we saw happening really quickly here. And so really the question investors need to ask themselves is, what does the forward... I do get these questions sometimes about using the past earnings trends to extrapolate those out to the future and whether that's a good idea. Well, because that's what I do on a lot of strategies, especially if it's a well-established business that's in the S&P 500 and has been around a long time and has been growing earnings less than 10% a year for a long time. And especially if you want to identify like previous cyclicality, it really helps to go back in time and see what's happened in the past with their earnings to get an idea of what future earnings growth might be and to see how fast they've really grown as a trend. Now, you have to control for some other factors, but that's actually a good method most of the time, about 80% of the time, for well-established businesses that aren't growing earnings like super fast, but they are generally pretty steady. This is different in that earnings were growing very quickly for several years. At least since 2018, the slowest year was 19%. All the rest of them, they grew earnings over 30% a year. So that's extremely fast growth, and it's you don't want to pay too much for those businesses. And I've covered some on the channel before, and I'm basically going to use the same method here. But you have to realize that if earnings growth slows relatively quickly from those levels, the stock price is going to fall a lot. And the earnings multiple is going to compress down to a more reasonable level than, what was it, 40, maybe up here even close to 50, 45. So that's really high. It's hard. You have to grow earnings over 20% a year for 10 years to justify that, maybe closer to 25% a year. And so if they're growing 6% and then 11 and 13, which is what analysts think here, that's not enough to support that. And that's what we see happening here. But the thing is, earnings can surprise to the upside too. So this is what analysts think, but that might not be what happens. I know when I don't remember exactly what the numbers were when I bought it, but they definitely surprised to the upside. I think especially in 2024. I think they might have surprised in 2023 as well with 37% earnings growth and then 45. So when that happens, that's how you get 100% returns over a relatively short period of time. And that's one of the reasons why I only sold half, because what if they grow earnings 20% and then another 20% or 25 and 20? I don't know what's going to happen, but they could do that. And if that happens, then it could trade back up at a higher PE multiple again. So that's my story with my history and kind of how I think about all this. So let's look at the numbers. I'm going to use 12% earnings growth, which is in between these next couple of years. And then we'll see what the time until payback method looks like for the stock. So the way the time until payback method works is you need an earnings yield, which is the PE ratio inverted, which is, on this case, it's 3.35%. And I used forward earnings. So I'm going to use the $2.50 per share that analysts expect this year. Okay, right here. See what FastGraphs does have a earnings yield right here. It says EPS yield of 3.29%. That's very similar to what I have. They use a blended PE to get that, which takes the past couple quarters and the next couple quarters. And I'm just using the forward. So mine's probably a little bit higher because earnings are expected to grow a little bit. So those are the earnings. You take the earnings in the price. That gives, it's actually earnings over price, the EP ratio, and that gives you 3.35%. Almost exactly the same as the fast graph, actually. And then you need the earnings growth rate. And then I'm using a 12% earnings growth rate because that's what analysts expect the next couple of years. And then you also want to zoom out and think, okay, is that reasonable? You know, they only grew earnings 6% this year. Is that reasonable? Well, I don't know any better than the analysts whose job it is to try to guess. So I'm just going to use their guess. But it seems reasonable when they've grown earnings at like 30-40% a year in just the past couple of years, and now they have one slow growth year of 6%. That, like, give or take, we're just doing estimates here, 12% seems reasonable. So the way I like to think about this is if I bought the whole business for $100, it would pay me $3.35 the first year that I owned it. I also pull forward the first year's growth too, but you'll see in a second. But you can basically just look at that earnings yield number and think, look, if I paid $100 for the whole business, that business of mine would earn $3.35 the first year. And I could just keep that money, and the business would keep earning $3.35. And if I owned it, I could take it and go buy a boat or something. And then not only would you get that year, but the next year it will grow 12%, and the next year it will grow 12%. The amount that you earn would. So that's what this is. This spreadsheet here is set up to calculate. So what I want to know is how many years would it take to earn back $100? If I paid $100, and it could be a million or billion, whatever. It's easy to do it if you use 100. How long would it take to earn back that initial investment from the business's earnings and earnings growth? So if we scroll over here, so in this case, since I pulled forward that 12% growth, the first year you would earn $3.75, the next year $4.21, the next year $4.71, the next year $5.28, and you keep that and it accumulates all those years. It would take about 13 years, right? Yep. So about 13 years to earn your money back from the business. And then you would have paid for the business, and then all the profits after that would have paid for your initial investment into the business. Would be beyond what you initially invested in the business. I like to see this number for a business that's kind of growing 12% in that range at 10 years or below. And then on the high end, usually I consider selling if it gets up to about 15 years, especially if the trend is multiple compression, if earnings growth is slowing, then up to around 15 years, which is a lot. If you think about it, it's like it takes you 50% longer to earn your money back if you have to wait 15 years than if you have to wait 10 years. And if you start compounding returns like that, you can think you could quadruple your money in 20 years if you earn it back in 10 years, and then you can invest in a similar investment that will again double in another 10, right? So if you have to wait 15 years, it would take an extra 10 years to quadruple. I mean, that's where the compounding comes in. So when I sold, I think it was around $100 a share. It was at that 15-year level, right? So the valuation was pretty rich, and the trend was slowing earnings growth, and so it made sense to take some of those profits off the table, and so that's what I did. Now, in order to when to buy it potentially again, assuming this 12% earnings growth holds, I actually didn't check this yet, but I can do it right now. I'm gonna say we're probably looking at like $45 a share. Hey, there you go. Like, that's 10 years. That's probably a decent spot to aim for. Maybe 50. Yeah, 50 is even too much. I would say that $45 mark is probably where you would want to aim, assuming that you think they can grow earnings at 12% a year. So it still needs to come down. The valuation still needs to come down more. I'm not sure what the history on that looks like. What are we at here? 30 PE. That was like 32. It got down to like 27 PE there. It's probably going to be lower than, when was it last? What did I say, $45? Yeah, it traded that much just 2 years ago, basically. Right here, maybe we got, yeah, 44.12 here. Not sure if that was at the beginning of the year or not. But so only a couple years ago it was down there. I think it could easily sell off more, even though it had that big drop. I mean, it dropped most of that in a day, but it kind of started to ahead of time. Like 25% in a day or something like that. Once the short sellers kind of get in and start pushing it down, I think, even on a technical basis, this looks like there's a little bit of support here. So if you wanted to nibble, that's kind of the I certainly wouldn't pay more than 50. I don't think at this point. And in between 45 and 50, it starts to get interesting. Where was this bottom? 55. Yeah, I would use more of these two right here, which is down in the 40s, but under 50. And then this is under 52. It was like 40 something. So that would be my approach with this one. Like I said, I still own half. I'll probably just keep holding it and see what the business can do over the more medium term, unless something strange happens. But hopefully that helps you guys and gives you some kind of a guide to use if you're thinking about maybe getting in on the dip here. All right, thanks for watching, everybody. I have weekly picks over on Patreon for $25 a month. I have a free tier over on Patreon. Check those links out down in the description. I'll see everybody later.